Hello friends, welcome back to my channel Finance Seekho India. Today we will break down HDFC's Q1 financial year 26 results. Whether it beat or missed estimates, analyst reactions, margin performance, management guidance, and what investors should consider going forward. Before that, please subscribe my channel and ring the bell icon. HDFC Bank recorded 18,155 crore in net profit, up 12% from Rs 16,175 crore a year earlier. The results were bolstered by strong other income and come with a Rs 5 per share dividend and a bonus share announcement. However, provisions surged over fourfold, making a cautious note. So friends, now let's check the analyst estimate. Did it beat or miss the estimates? When Q1 forecast hit the street, brokers projected HDFC Bank's PAT around 16,400 to 17,226 crore and NII between 31,400 to 31,900 crore, implying modest single-digit growth. The bank delivered a strong beat, posting Rs 18,155 crore in profit, well above expectations. NII also rose as anticipated, but margin compression was visible. In summary, a clear beat on profit with a steady NII, but rising attention on margin stability. Year-on-year loan growth remained moderate at 6 to 7%, while deposit spiked 16%, reflecting stronger liquidity. HDFC plans to reduce its high loan-to-deposit ratio to pre-merger level of 85 to 90% by financial year 27. NII rose as expected, but NIM compression persisted due to interest rate cuts. So now let's talk about the management commentary and guidance. CEO Jagdishan confirmed that loan growth will match or surpass the industry and LDR will adjust toward 85 to 90% by financial year 27. The bank expects NIMs to stabilize once the rate cut pass through. They also announced a bonus share issue which supports shareholder value. For investors, HDFC remain a hold or buy, driven by strong deposit inflow, proactive LDR management, and capital returns. However, keep a close eye on margin trends and rising provision expense. On chart, a breakout above its 2000 to Rs 2025 range could indicate further upside. Now let's understand what's the risk associated with HDFC. Key risks include prolonged margin pressure from rate cuts, rising credit cost, and the need for seamless merger integration with HDFC Limited. Success in these areas could unlock long-term value. Now let's do a quick recap. PAT grew 12% to Rs 18,155 crore, beating estimates. Strong deposit growth improved LDR strategy, but margin pressure and rising provision need attention. Investors should hold or add, monitoring core profitability and macro trends. Thanks for watching. Hit subscribe and drop a comment. Do you see HDFC in your portfolio? Thanks and Jai Hind.